Greetings, market rebels. Welcome to this week's macro measure. It's Sunday, August 6th, 2023, a little bit after 11 a.m. here on the East Coast. I'm Wayne. My partner Ryan's working on the market outlook overview for the week. Should be coming out later, along with links to this weekend's videos. So let's do our thing. Just get the critical stuff like the trustee disclaimer flash for everyone. And we will also flash the trustee intellectual property rights notice. And then we are going to hit on just a very brief time on last week's stream. You can grab a snapshot of this, just a few brief comments. So I highlighted the big things, right? That we said the week before really had went about as expected, and that news and the earnings reactions really ratcheted up volatility. That was really, again, I think the case. We really didn't have a strong lean. Right, we did not have a most likely scenario really in place where we said, oh, this is what the market's going to do. And that's because of the unknown really of the EPS deluge that we just went through that really included Apple, the biggest market cap, and of course included Amazon as well. We did note last week and had for a few weeks, I think, that we thought we were in the latter innings of the rally. And so there was that. And then we also went to DEFCON 2.5, which was a little bit of a joke, but can only go to DEFCON 1. So if you're 2.5, you could move to full preparedness, and then you're playing defense right after that. So going from DEFCON 2 to with a 2.5 with an issue trigger finger to DEFCON 2 doesn't take very much. And I think that started to appear enough. There was enough there to do that. And then of course, to go to 1, you had to go to 1, I think, after things started getting rough in the latter half of the week. But we did say that the sweet spot window we've been tracking would close, and we thought that delusion, the Apple, Amazon earnings, along with the other names, would be the big deal. I think that was the case. Here's this week's stream, which I'm going to leave up and then reposition. We'll go through it somewhat methodically. That's why I call this a stream, because I don't tend to go presentation style. It kind of jumps around, but it's just tough to do, especially without any. Just the time factor alone is not easy to get working, but we'll leave that up for a few more seconds, then I'll reposition things. So just bear with me if you take your screenshot, you can always check and go through this with me. But we're going to stop the share briefly, and we're going to get out of I'll move this over to my other screens so I can follow along, and then we'll bring things back a little bit. Actually, I may just bring it back right away and just stay on the screen, and I'll move it over later. So let me do share and get the right screen here. So I'm just going to leave this up this way for now, but I think last week, and I'll start at the top line, right? This also really went as expected. The EPS and the news, of course, really impacted the market, last week's news, and that ultimately brought about selling. And so I would just remind everyone that if they were able to take the Apple release and spin that, or just Apple's release was awesome for whatever reason, it could have been a different scenario, right? It could have, if Apple had joined Amazon, it could have been a really different scenario. So that's why I'm reluctant to make most likely scenarios and pound the table on those in front of EPS, big EPS releases, along with all the other ones we saw last week, because it can really go either way, right? And that's been my experience. So again, when you're betting heavily and you don't feel as though the probabilities are heavily on your side, I think that's when you start getting closer to gambling rather than trading. But anyway, they lost the 20 SMA support we've been watching, and we've been waiting for that to possibly be the case to really potentially open the door for more corrective action. And now I would say, look, overall, it's probably likely that we visit the 50, because I still think there's more corrective action in store for us. And I think that's really where the trend that we've been in since the October lows, that's really where it's going to be threatened. I don't think the trend is threatened yet. It would take a good cracking of the 50. So as I note here, door, I think, is now open to more corrective action in accordance with the third year, which we'll look at, and the typical year, right? Just your basic year in, year out. There were overbought readings that were still in place, and right, that could last months if it takes hold. In other words, right, like this corrective action that we think is on the way, it may take a while to sort out, and we'll look at that. So I'm going to do the tabs check now, but I will apologize as I move this off screen because I wish this could be super short, but my whole argument is that you should just jump ahead or take a nap right until we get to the charts, if that's really all that you're interested in. And I don't blame you if you don't have time, then go right ahead. But I think the big question now is there, we started to go risk off, and is the acceleration about to intensify right here? So, but I think the whole problem with jumping ahead and not really understanding what's happening, what news has recently started to crop up or impacted the market, I think you should let your chart reading be informed by the market environment. When that's more of a feel thing, we talked about it on cocktail hour, that you need to almost evaluate things, right, that in my mind that way, to really dial into what's going on. And I think that, for example, a lot of news which wasn't all that great was brushed aside for the longest time, maybe in some people's minds for 9 months. And you know, now the market seems to be not doing that so much, and certain things have cropped up that are concerning. So with that, let's just keep going. I will move this off screen. We'll flash the chart up here, but we will then get to my tabs that I've got waiting somewhere. Those tabs I think are going to be down here. So this is a massive tab thing to get through, but I'm going to go through it as quickly as possible because I know people prefer these videos to be much shorter, but I'm, like I said, I'm doing my best. I think I'm going to start planning to just do basically a tabs only video at some point in the future, and then do the charting in a separate video, and then do the sectors in a separate video. But I might have to start doing some of this on Friday just because it's a tough weekend slog, weekend after weekend. But anyway, this is, I think, important, right? This is one thing that's super critical in my mind. I kind of feel like people are forgetting about how important interest rates are to a capitalist economy, and or at least semi-capitalist, or at least ostensibly capitalist economy. But you can see, right, the rates, these two bars added together come to about 64%. And so that means, right, that we're expected to be where we are, or even potentially higher, really through the end of January. And so you're just at the start of August, right? So that's 6 months from now. And remember, this is the context part. Remember, the gang was trying to tell us in the spring, is my recollection, somewhere late winter to spring, that there was a good chance the Fed would pause soon and then start reducing rates. So they had that priced in, or they were selling that to whoever would buy it sometime in, I don't know, April or May, I can't remember. But the point is, you know, we were skeptical of that, and I think our skepticism has paid off. Again, not fighting the market, but didn't believe that story. But I think a lot of people started believing that story and went in. I think a massive amount, I mean massive amount of money has flowed into this market. And I think it's possible, right, that came in too early. And remember, this has to do with the victory dance that I've had on the slide that you can maybe follow off screen yourself. But they were thinking, right, that everything's wonderful. And recently, right, with the tremendous performance this market's had in the SPY and the Qs, especially the Qs, since the October was nearly 53% advance, just remarkable in 9 months. Something that, you know, not that it's unprecedented, but it's just an incredible opportunity. I mean, I think it really has been. So again, even if we have a disagreement on the big macro scale stuff, which we do, we'd never really just trade that. I mean, some people I'm sure do, but they probably have a much better informed macro take than I do, because they've got the time to focus on that, or at least they've got teams that can focus on that and they can digest it. But I still not buying what the bulls are selling. Some of this I'll talk about later, but we have to get the context established here because there's a lot going on. Now we did chart this a lot lately. This is the number percent of stocks above the 20, 50, and 200. And you can see, right, that we did get to a high place. It wasn't super high, but it was pretty darn high. And so now these are correcting. Is it through correcting? I don't think so. I mean, I think the kind of rally we've seen really since late winter into and through the spring into the summer here, deep into the summer, you know, I think there's more to the downside, honestly. But just to be thorough, we'll flash MMFI. MMFI, and this is, you can see that has a lot more room to correct if it really does, we go through a serious correction, and then MMTH. But this was critical because the bottom line is right here, you can go a lot further down from here too. Now, again, this is one that really didn't get super high. So you can draw whatever conclusions you want from that. There's plenty more to go, or this post-COVID madness is incredibly rare. And so you are relatively high if you basically surgically remove that from the chart. And that would probably be somewhat true. Maybe there should have been better participation if it were the start of a real bull market. We don't know. I don't want to draw too much from one snapshot in time chart. That's what I try to not do, because I think it's a lot more complicated than I wish it were, to do all this, to really get a sense on things. That's why I kind of call it an art form, more than, I think it's a combination really of analysis and art that you're ultimately coming up with. If you're just a regular player, not somebody who's got a team of PhDs cranking out numerical calculations for you. But the whole point was, right, that we had this, let me double check on this Zoom to make sure it's got the right, I want to make sure it's showing the right screen, and it is good. Yeah, we were way up here at extreme greed, and we've been noting that, and we said, this has been persistent too. And so that's when you really, I think, have to keep your eye on it, because if it's persistently that way, eventually they come around and get their hands on it, and that's what they did. So I think now we are looking at the fact that the gang worked their magic, and they got this, they used, right, the calendar to do very well with it, right? The Fed pretty much started to, as the gang was forced to realign with a different path, the Fed decided to go down, other than the ostensibly really bullish one the gang was selling. The gang started pricing that in, acting like it was unfazed. And then really they used the Fed, right, the economic calendar, the earnings season, really to maximize, right, their jam job. And I don't see, the problem with that I don't see anything, right, between now and like sort of about 6 weeks from now when the Fed does their thing in September. So the Fed can always cut. It's rare, but they can always cut between meetings. You never know. But I don't see that coming as of right now, unless there's something that's nearly catastrophic. And so that would mean, right, we have the correction we're thinking should take place overall soon, right? Anyway, so either way, it's probably a situation where you should see more corrective action. We've talked about that in different ways. So I still think there's more upside to be tapped. But the question is, right, do they tap this sooner, which it doesn't look like it, or maybe later? And you just don't know. And I think the really big question is, are we in a bear market? Was this a bear market rally, and we're still in the rally because it hasn't cracked fully yet below the 50 in a meaningful way? Or is this the start of another leg down within maybe a longer term bear market, excuse me? So we don't know if this is a corrective leg in a new bull, or it's just a bear market rally that ultimately leads to a test of the lows or even lower lows. And I don't know about that. So that's a tough call. I don't like to get that far out in time. But what I would like to note is that, right, you're still not really into anything near fear or extreme fear. You're not even in neutral, and you have a ways to go, despite, right, the recent damage that we saw. And interestingly, right, this is the bull bear stuff we've been looking at from AAII. And we saw this when they get on these extensive runs. Once this ages, it starts to, right, become, I think, a little more contrarian, right, as it ages, and contrarian in general. But that really spiked back up almost towards, right, the 1 year high. You're not that far off the 1 year high. So that is interesting, because that tells me that this, right, that bullishness needs to correct. And in fact, if you plot the difference between bullishness and bearishness, here it is, the AAII bull bear spread. You could see, right, that you rarely are higher than this. The only time you were higher really than what we saw very recently on this is right, basically coming into the end of 2020, and then after the COVID response from the Fed and the government. And so that was obviously euphoria in both cases. And what happened after that. subsequent to that. So this is pretty darn high. I mean, look at that versus all the other highs going back years. So I would be, this is one of the reasons why that, we haven't shown that, but that's one of the reasons along with this that we've been saying, right, let this thing run its course and wait to pick a fight overall, right? Because the trend was still up. And remember, right, this third year tends to be really good, and it has. And so things are really working in accordance with this, whatever you want to call it, an analog for that third year of the presidential cycle. But as we've been noting for the past few weeks, there's been a sweet spot sunset coming, and it's happened now, right? The sweet spot is effectively beyond, we've moved beyond it in terms of time. And so you could see that just in the Dow and the Dow and the NASDAQ, that we start to get, right, in a typical third year, you tend to get this kind of performance, right, where you get a little choppy, to say the least. So that's fine, because, right, a lot of the stuff we do is just, it's all about, as long as we get movement, we're going to, hopefully fare well. That's all we need is momentum. But it makes sense, I think, in the larger context, for a lot of reasons, including this one, that the sweet spot's done, and you should see some back and forth now of corrective action for a little while. So I think I've been noting that in a lot of the services, in some of the write-ups for ideas, that I think you should really be about some singles and doubles for now, and it could get choppy, so that's going to mean rolling, trimming. It's going to be that, and we all love the phase we've just been in, where you should still roll and trim, but you're basically doing better if you're a little more patient. And remember, this also coincides with the VIX seasonality, which we talked about. So that almost started lifting, as Ryan noted last week in one of our webinars, or maybe in cocktail hour. Boy, that started lifting up kind of like right on cue, right? So getting back to the whole story, which we'll talk about some of these other things, but yeah, I think some of it was the TNX and the DXY. They ratcheted up, and now they did correct at the end of the week, right? But we did note that for a few weeks to keep your eyes on those, because they started to perform, and that's normally not a good sign for the market, and it wasn't. And the VIX, we noted, was really sub 13 briefly, and really down on lower levels that we hadn't seen in years. And so not a bad time to position yourself for that. And I've said, I think folks should, folks should really make a smart move into the Phoenix portfolio to learn about how to hedge. That's where we cover hedging. There's a lot of different ways you can do that. Also positioning yourself on the right side of volatility at the right times, generally speaking, right? So that was something that I hope some folks took advantage of. I want to note, right, that the story, this is just a long way to say that I'm still not buying the story. You can look at the freight volume and spending declined markedly in the second quarter, right? I'm not going to spend time on these because I'll just catch more flack. Where services surveys signals stagflation, right? Slowing growth, sticky inflation, not a good combination, right? Now there's about 70 billion in systematic selling that's supposed to be creeping up in the market. We've also got CTAs that really could have a problem on their hands in terms of them flipping, right? I should say the market will have problems on their hands with them flipping. The inflation, right? The argument some people are making now is that the rising yields that we just saw, that shows the market sensing that inflation is still a problem. We did note recently, right, that breadth was an issue. And so this is another view of it. So the breadth really got hammered recently, right? So it just seems like folks are finally waking up a little bit. And after the run, and we noted that, right, after the run that we saw, absolutely makes sense that you would see corrective actions for so many reasons. And we've been saying that, right? The only holdup for me was the fact that you could it's all about the path, right? As a trader, you can be dead on, right? But if you're too soon or too late, right, or you don't handle it properly, it doesn't work out ultimately. So bottom line, we were waiting for that, but you had to get through Apple and Amazon, and you could see what happened. I think it could have been a different story, but we talked about that already. Had Apple pulled off an Amazon type move, which you just never know. I mean, I'm not an Apple analyst, full-time Apple analyst, so I really couldn't tell you that I saw that coming. Maybe some people that have enough time to spend on Apple did. Anyway, so right, you usually have a decline after that kind of a July. So that's the point of this one. So yeah, you might see like a pullback here, right? So anyway, that's something, just another little tidbit on that. And then here's a federal debt as a percentage of gross domestic product. So you've got to go back to World War II to find anything close to where these so-called leaders have brought us to, at this point, with their mismanagement. The question is, I call it intentional mismanagement, but because they've all fared extremely well at everyone else's expense. But again, that's probably nothing new. It's just more obvious and probably more egregious these days. Anyway, another sign that, you can, I'm not buying what the perma bulls are selling. Ryan's not buying it either. Credit card interest rate. I wish I were. I wish I felt better about things. I really do. But credit card interest rate. Look at this. Just look at that spike, right? Look at that massive 50%-ish type spike here. So highest rate we've ever seen, right? That's not good for people that are needing to tap credit more and more, right? When you get as high as we did with inflation, right? It takes years, not months, before it falls back to the 2% level. So again, the story they were selling, another like kind of nail in that coffin. And that coffin's has more nails in it, I think, with each passing day, because they just, again, this is what they do. They spin stuff. They get people excited. People feel forced to capitulate. The whole works, but that's how the market works. It's always worked that way in my experience. Another bad sign for potentially lower prices and really putting a hit on the consumer. Crude inventory is the lowest since 1985. So not good. U.S. crude inventories. Price, maybe it's just related, but U.S. gasoline prices are now at the highest level since October 2022. So again, not something that's good for the consumer. Good for probably the energy companies, and that's why when sector situation, we've been noting they've been doing better and better. Also, right, it looks like Jane and John piled in with call buying, right, to an extent that you haven't seen really, right, since the post-COVID response mania. So that is extraordinary, right? And another factor there is that they're also piling in, of course, right, with net purchases of equity, not just options. So it's them doing their thing, right? It's the public going bonkers at absolutely the wrong time. Here's the global situation largely, right? Like we know that other large countries' GDPs are under pressure, but here's the China situation viewed one way. And we have a trader that's part of some of the market rebellion services that's also seeing things this way, that is dialed in very well to what's happening in China, certainly relative to me. And he's not impressed by what's happening there, to say the least. So the market's ignoring that, but regardless, right, that's what's going on. That's not the right, that's an extra tab I don't need. So let's see here. Yeah, so, okay, so this just gives you an idea, right? Here's your dividend yield if you're buying right now versus the 10-year, right? So think about, like, you could get into the 10-year and get a far better yield relative to the dividend yield that if you're paying these prices for the S&P. Here's your global government bond index yield, right? This is making new highs. So it's not like other places are backing off. It seems like, across the board, aggregated, right? It's about potentially, at least ostensibly, controlling inflation, not about stimulating economies. So I don't think that's a good situation. What's this one? Oh yeah, so this is just an argument that the market's detached from the economy. This is, I think, Lance Roberts, who puts out, I think, pretty interesting stuff on a very consistent basis. So kudos to him and the other people that put some of this stuff out there on Twitter. But this is it. Just gives you an idea on what happened with the pandemic stimulus. And you can see, right, the government interventions versus cumulative growth. And so I think the point they're making is it just keeps taking more and more stimulus just to keep growth going. They just got to keep doing this. And it maintains the illusion, but it's just not a way you can go forever. How long, I don't know. And then here's another important one, which is probably why I scrolled down, is that you can see how you are in terms of the real S&P 500 versus GDP. And so here's your GDP, right, in red, and here's your S&P, and you're not as stretched as you were, right, post-COVID, but you are still very stretched from here. And you can see this tends to be mean reverting over the course of time between equities overreacting in both directions and then correcting back towards, right, something related to GDP. But it can stay detached for a while, as you can see. So again, all the QE, all the shenanigans that have gone on, not a surprise at all, right? Since the 2000, this bottom, to see that right, that that equities are supported by all that, and of course they're detached from what's really been happening. Payrolls have farther to fall as tighter consumer loans point to falling job numbers year over year. Not a good trend there, despite all the nonsense that's out there. This is interesting. U.S. workers taking vacations are at the highest level in over a decade. The percent of people working on a given day is the lowest level in 20 years. So, that is not what especially with it's just not a great situation overall for Jane and John, employee. Right. Here's the situation in terms of aggregated percent of stocks with MACD sell signals, right? And you can see, this is not bad, right? In terms of when this is flashed up as high as it is right now, or very close to it. So there you go, right? So that's not good when a lot of things are rolling over. No surprise there. This is what I was talking about later in the week. When did this come out? Yeah, because it came out on Friday. So I think I talked about this on Cocktail Hour. But this is what I was referring to, where look what's happened this year, right? So every month they've had to revise lower the non-farm payroll. So it's just been the same old government chicanery where they, let's put this number out. The market never really seems to care that much about the revisions, so if you can fake it the first time around, you're good, you're in the clear. And that's what they've done consistently, right? Any kind of legitimate expectations, right? Any kind of legitimate thing would have errors in both directions, right? But you can see the error always favors the government. This is true under any regime we've ever been under. And then that the median home price, this just gives you an idea. Now, granted, this is a snapshot in just a few places, but it gives you an idea on price to median income. And so I wish we had this more of a national look, or at least in several other geographies aside from here. But you can just see, right, that this stuff has gone bonkers relative to people's incomes. So again, it's a case of affordability. And then finally, right, I think this is really a big one because this is one of the biggest shippers in the world. I forget what they said, maybe like they ship 1/6 or 1/8 of all shipping worldwide. This one company, which I guess is called Maersk, which I've seen and heard of, but I'm not sure if I'm pronouncing that properly. But anyway, the point of this is that you can see that things have really continued to downtrend. They're hooking up a little bit now, so hopefully that's a good sign. But there's concerns about this, right? We're in the midst of the biggest. This is the CEO. We're in the midst of the biggest correction after the boom from COVID, and so they have expectations of a prolonged inventory correction, recession with risks, and weaker volume. So that is here's your freight rates, which are down 51% in Q2. That's really a spanking. 1/6, there it is, the world's containers. Massive, just massive. Anyway, that's the run through. Let's get back onto the charts. And the first one up is not the one I want. So let's get to the next one. This is our basic chart that we look at here for what we do from week to week and evaluating things. And I won't spend a ton of time on this, but what I want to do is show other charts. So let me see if I can find those other charts. One of them is here. This chart, let me kind of blow this up for you because I'm sure it's hard to see on my screen. But the point I'm trying to make, and let me see if it lets me do this. It may not, because I've got a lot of indicators on there. The point I'm trying to make here is that a lot of the stuff that I track, right, and it's not something I really look at in the moment, but it's kind of background stuff. But this is the McClellan oscillator, and I'll enlarge that. And the McClellan oscillator, you can see that really has corrected. right? And that has been correcting. And so this is this is one view of and measure of breadth. And the bottom line is, right, under the surface, things have not really been improving as the market ground its way to those highs. And this is one of those warning signs, right, that you should be on the lookout for. We probably should have covered this, even though I tracked it and looked at it. Probably should have been covering this more, honestly. But you can see that the summation index, which is really longer term oriented, this peaked out finally and started to roll over, took out a low. So, right, that sort of tells you that you have something like this here. So I think again, it's another sort of pointing to corrective activity should be the case. Now, the problem is, right, that you're probably a little bit short-term oversold at the minute, this minute, like where we ended. Let me see if I can get the right chart. Oh, I wanted to show this. I got a lucky guess for a change on all my layouts, but this is something that Ryan's been flashing on his charts, which is nice. This is the percentage of stocks, right, and you've got to go from the 50 in gold, and the light gray is the 100, and the purple is the 200. So on this, right, you can see that we peaked out in terms of percent of stocks above those SMAs, and we've been losing, right, more and more stocks have been starting to drift as the market continued to hang in there. So again, I've noted this, right, myself, but probably should have been sharing it. But this is one reason why we keep an eye on the breadth, because it's not as if the moment you start seeing it crack, it's over. You still generally have to wait. But the point is, right, that under the surface of this market over the past few weeks, they've been bailing. I think there's been a lot of smart players that have taken the money and ran. And so notice on the SPY, there's a gap back. Oh, geez, Thinkorswim's got me on percentage this year, so my bad. We get that fixed. Hopefully it doesn't revert, but you can see that we are near a gap high. The high on that day pre-gap is 443, right? So we would have to come off another percent. We still wouldn't be at the 50-day, which is at 439.65, almost down another percent. But I think, right, to me, like that's really where this trend that we've seen since the market pivoted here in mid-March, that's where this trend would really start to get cracked in my mind, is if it loses the support of the 50. If we went back a little further, let's see how we look. I say, let's go back 5 years, and then we can just adjust from there. But this is your October lows, so we would have to kind of say, let's see if we could just drop in a longer term support line while we're here. I've got a fib from there, so it might not, it's letting me, that's good. Sometimes it won't let you put it on the same exact spot. But that would be, right, I think if you connect these two major lows, you're somewhere near my rust colored 150 now. So this is where I think you start to see this shorter term trend. Intermediate term, you could almost stretch the intermediate term from here in that mid-March. That's where I think that cracks at the 50. Probably, right, though the bulls would have to really lose the 150, which is, or the support line. It's got to be in the 30 points away minimum from here. Now, by the time that could happen, should it, unless it's really, really severe, it's possible the 200 will be moving up to that level, given all the prices that it's going to lop off from back here and add, all the prices it's going to have that are above there that it will probably add for a while. So that could pick up, but essentially, right, your 200, yet again, maybe the line is in the sand. But the problem is you have to remember that the gang is great at getting people to capitulate, right? So nervous Nelly longs and shorts that are too aggressive. I mean, that's why there's so many games that get played even on the way down, even in bear markets, right? Where if you overstay your welcome and you don't adjust your positions, it can really put you through living hell with how far things fall and then how quickly they're able to recover. And all you have to do is go review the 2022 charts, and you'll see, which I probably should bring up here, how severe, right, some of those rallies were. I mean, look at this madness, right? There's a massive recovery rally. There was another massive recovery rally. And it is kind of absurd, but that's the game, right? That's the game we find ourselves in, and we should actually probably be thankful for it, because that's a lot of opportunity in terms of momentum trading, right? So if we do have a corrective phase, I can only hope it's as good as 2022's corrective phase, because that was really, I think, a great market to trade if you were willing to go with the flow whenever they treated us to a massive bull run or another drop. But beyond that, right, there's a gap back here we noted. So that also could come into play, which will put you maybe near the rising 100, rising 150. If this really takes hold, there's another gap we should drop an oval on before I lose sight of this, because I usually do that in real time, but I can't always do it. I'm under a lot of time pressure every day for most of the day. And then when I'm not, I'm still under pressure because there's still a lot of other things I have to get back to. There's a few gaps though, right? And I kind of ignore them. Ryan and I have talked about this. Greg mentions it in Rebel Pit quite often, right? That we did a study, and if the gap doesn't fill within 4 to 5 days of the gap occurring, that we kind of start to ignore it and say that the market doesn't care about it at that point, right? That it's done as a possible short-term gravitational force or attractant. And you can see these are just held, they didn't come back and fill. You can see after a while, the market just says, that's fine, there's a gap there. Oh, well, we'll get to it later. But I do think when you start to do the return phase, that's when I start thinking about these gap levels as levels that the market could get to. Now, the smart move to me is to not plan on a complete gap closure. Plan on maybe them getting close and being smart about watching it when it's close. If they get very close and they might not let it get completely there, because once again, everyone is watching for gap closures, right? Everyone knows that gap closure is a thing, and that they're looking to get, everyone's looking to buy. And of course, the market at a certain gap closure point or somewhere near there, and the market does a great job of frustrating the living hell out of people at times. And that's one way they do it. So the other side of the coin would be that I think, right, this is interesting because came to the 20 on the light blue line, found support there, held, didn't crack, right? Not in a meaningful way anyway. Next day, they test the 20 from the underside. It couldn't get back above and close. Next day, they open right below it, try to rally it above there. They hit the 15 and 10 red and white, and then they roll off, make a new low for the week. And you're right on this line that I've got from support, right? Which is basically like from a GAN fan. So bottom line is that, look, they touched this 20 3 times and we're not able to rise back above and hold. That could be what you need, because I often say this, right? That a lot of times the market or a stock will go back to a critical level and then touch it from the opposite side. So in this case, the underside from where it had been. And then if it can't get back through there, then it kind of has that, okay, well, it wasn't able to do that. And people start saying, well, that's failing to do that. And it brings about, more selling quite often in this case. So that's what I would watch for still. But I do think it's possible they already did their work there intraday, that they don't really need to have like a big swoon and then take it back up again to bring it back up to there maybe later this week. That could still happen, of course. But I think overall, the problem you've got if you're a bear is that, for example, on your hourly chart on the SPY, my RSI reading is about 35. So it's not oversold. It's getting there. It's slightly like approaching, oversold. Doesn't mean it can't bounce from here. Just saying it's oversold almost, right? So that's the thing. Like when you get breakdowns, you do break down from oversold levels. I'll acknowledge that. And this is why it's tricky. But at the same time, right, you would love to sort of break down and still be at like a 50 SMA. Now, if you come back to here on the 20 that day, let's see. Actually, I can't get that on this view. So my apologies. Let's switch to my other kind of more reliable basic view. And that is going to give us the RSI that day was 50. Look at that. That's interesting. The RSI, that's what I mean. So that fits really well with what I was just saying. Come on, Thinkorswim. Let me scoop this and make it a little larger for everybody to see here. And then you should be able to see it better here, and I'll boost it up by 1 magnification. But if we come back to that test of the 20, right, you were at a 54 reading if I round it that day on the daily RSI. So I think that's what made it possible for this to continue. Now, granted, it all fits together in a way, but at the same time, had Apple really changed the market's tune, again, I would argue that it wouldn't matter. It all comes down to how the market's going to treat things. But keep in mind that one of my other things that I've been noting is that I think a lot of people have piled into this market, and there's a lot of capital that has gone in. And I saw a lot of, I think, capital fleeing NVIDIA. I don't think they're waiting for that EPS in a few weeks. A lot of them have already bailed. Maybe they're expecting some corrective activity in the market. They expect NVIDIA to correct, and who knows, maybe they'll buy it back cheaper. But maybe they felt like, look, it's probably done as much as it can for now. But anyway, so yeah, I think overall, my most likely scenario is we continue to correct. I saw risk off in the sectors. We'll talk about that in sector situation a little bit, but bottom line is like only a few sectors did not roll over. Those are mainly energy and financials that didn't roll over as bad. They've been some recent late bloomers. And of course, energy has its own particular situation. Sometimes financials do. But here's another line that I have in there, and that really dovetails nicely with the 50 and the Qs. So I still think, look, the Qs are about 37 on RSI right now. Where were they on this particular day? They were at 51. So again, that's sort of what I do. It might help you, maybe it won't, but I like to see where I have a lot more confidence that there's going to be potential for more downside is in place if you don't crack a moving average from too oversold of a level, right? Sometimes you can, right? If you had fallen all the way down to the 50 last week and cracked it on Friday, sure, weekend news, whatever, could do this or that. But the bottom line is, if you were at like a 20 on your daily RSI at that point, I would think the gang would try to overall, I would think the gang will try to manufacture something to like take some of the steam out of the selling for a little while. Overall, that would be more of a different take there. But so you're not really overdone yet. Be careful, could be tricky, but I think, right, to really feel like it's over, and hey, maybe the market's not as bad as we think it should be. Maybe the corrective activity isn't going to be so easy to capture like we seem to think it should be over the next few months, or at least until the Fed meets in late Sep or mid to late Sep. Bottom line is you probably need to at least be back above the 20, but given that the 15 in red is so close to there, I would say, look, it probably needs to get back up there. So probably around QQQ 380 would put you on better footing soon. If you do that soon, let's pick that out in the SPY as well. These are the two, right, that I'm focusing on the most because they are the big dogs. I think it's a similar situation there. You can see the SMA. These have been tracking pretty closely. Probably a flat line could be, an argument could be made for a kind of like a mini flat line near 455, ballparking it. So I think you got to get back above there before you're like, okay, wow, that was a very small sell-off. There's a lot more buying frenzy yet to come. But again, I'm thinking most likely scenario is, yeah, maybe they do a little short-term rally, but I think that there's more corrective action on the way, or at least there should be. So that's my most likely scenario. Let's take a look at IWM and diamonds. And again, these might just be the 4 or so that I do in the future in their own video. And that way, you know, you could really, it's not a big deal. I mean, if you don't like all the tabs discussion, which I think is critical, but if you don't like that, you could just advance right to when you see a chart, when I get into the chart phase. But I might just do this to help people out that don't like to watch my tab discussions. But I think, like, for me, they're very important, you know, just to keep yourself apprised. You can see that there's room here now, right? So this was very late to join the party. We've been waiting for that. Luckily, we started noticing signs. Like, you know, a lot of the weekend work we do is very helpful for us during the week, because you kind of come in with a mental picture in your mind. And I don't need to spend a lot of time evaluating things fresh because I've done it, right? It's kind of like locked in. You might not memorize the chart perfectly, but you've got a good idea, like, hey, that this thing looks primed to start going, or this sector looks good, or this stock looks good, right? So, but anyway, I think your 190, probably right, last week's low is big here. Take that low out, right? And you probably start thinking, yeah, this also joins the party of maybe trying to visit the the 50 SMA. I think that's what you start thinking, right? And so with higher rates, for longer, you know, in smaller companies that need to borrow, and maybe the economy slowing, I mean, it makes sense for me to roll over. And let's not forget, there's so much to discuss, but I feel so much time pressure. Anyway, so I don't want to belabor this, but look, this is basically a triple top. You know, you go back and look at this, Let's give ourselves a weekly view. Oh, come on. That's not what I wanted to do. I'm going to better, a little bit bigger of a weekly view than that. There you go, 3-year weekly. You can see that if I can enlarge this a little bit, this has been right near here has been tough. And that you can see there was support in here. So it all kind of makes sense when you go back and look at these things a lot of the time. It makes a lot of technical sense, like why you're struggling somewhere. And if you're a weekly trader, some people are, they like the idea that you're almost above all the SMAs, and maybe you still find a way. Maybe you do. I can't say that you won't, but this is also an awesome example of running into serious resistance at a 150 week SMA in Rust, also a flat line or triple top scenario, and fake out above the 100. A lot of people don't run the 150, on the way that I do, but whatever. I find it useful. I find that it matters at times. Otherwise, I wouldn't keep it. But I'm just saying that that's a great example of what could be a false breakout in the end, triple top. So just be wary, of what's going on here. It's in some ways, it's looked better than it really is in IWM, I think. Now the other ones, SPY and Qs especially, they've been legitimately powerful, and they were the, SPYs were probably the leader, and Qs then picked up and really caught up and surpassed them. But same thing, similar in the diamonds, There's a lot of tops that are near here. And so it wouldn't be easy. And so maybe all we're going to do, is that on the weekly chart, it just kind of revisit some of these SMAs or the prior breakout point. And I'd put that at like 343. So again, everything's about 2% more lower. And then you'd expect some support to come in. If we get that downside scenario that I think is, obviously I'm talking about it because I think that's what we're most likely to see in the near future. And that's what I tend to talk about the most, is the most likely scenario, because I don't like the table pound. Anything can happen. The Fed yappers could say something. Some European banker could say something. Something could come out of China, geopolitical. You know the drill, and that can change everything. But look, I think a visit to the 50, and that's down a little bit, about 2% or a little bit more, and that's essentially your weekly 10. So anyway, you get the idea there. They're in about the same location. So you're clearly rolling over. Breadth is rough. You're short-term oversold, but not, or approaching it, but you're not really there yet. There's plenty to fall from here on greed, fear, and stuff like that. Sentiment's still too good for there to be a bottom. Market history says you should be expecting more. It's all adding up, So I think on that note, what I'm going to do is just call it, I'm not going to chart DXY and TNX and the VIX, because it's a whole different thing. And a lot of people really, that's not their favorite stuff anyway, but from what I've gathered. But anyway, let's make sure we covered this. So as we've noted many times, as I just said, now should be a corrective volatile phase. This really did start to tip things off. I think it would have been a smart move. It still is a smart move, really, to get into Phoenix if you, it's diagonals and other strategies that are the main sort of strategic focus, but the discussion and hedging and how to position yourself with vol and really how to hedge your portfolio at times, a lot of good stuff that's more macro, it gets discussed in there, along with ideas on ETFs and some stocks as well, So it's a kind of a grab bag, but you kind of need a service like that. If the way Ryan and myself and Greg, I think, approach the market. No doubt they were able to do this, but we did note the rally remained in the latter innings. We've been saying that for a few weeks. We weren't sure if it was the 8th, 9th. It kind of got closer to the 9th, we thought. Seems to have been the case. Also, we were wondering, what are they going to do? Are they going to put one final remarkable move together, or are they going to sell on news? And I think they sold on news, I mean, that's what we had to wait for. So a lot of that great stuff was priced in. Ultimately, you didn't see a lot of awesome runaway earnings and the whole market really running with it in a big way. The news did provide them cover for profit taking. Now that, look, Apple didn't report, it's our big dog. Hey, we better take profits. Again, using the calendar. And this is something that's cropped up this week, that just keep an eye on that, because a lot of people are saying that I follow, hey, there's been some stealth fiscal stimulus. And that's kind of what and I had a typo. I have a bad keyboard and I keep complaining about it, but not buying a new one for some reason. Kind of a statistical there. That's how you spell it. Anyway, maybe a large part of the mirage. And we talked about that. We showed that what the government's been doing. Again, it's every administration, so don't take it personally. If you're a fan of what they're doing right now, C19, right? That we're dealing with some money too that's sort of recirculating, according to some people, from that was jammed in after C19 a few years ago. That I can see that. I can see the mirage. I believe there's been a mirage the whole time, but I didn't know what was causing it exactly. But it definitely, who knows if it burned off too. So we did kind of come in with that idea right there, and they just sold on the news, as we noted. I would stay at DEFCON 1, right? We were at DEFCON 2.5 with a wink last week, which is really, right, you get to DEFCON 2.0 very quickly that way. And then once you are there, you're ready to go to war or play defense in the way we look at it, not go to war. Hopefully the wars won't be something that concerns any of us for a very long time. But in terms of that mindset, yeah, you had to get into that play defense mindset. So I think you're a little oversold, but I still think that the corrective action is what we're likely to see. I'm still hoping to be wrong, but again, you saw the tabs. If you watch the whole video, you saw those tabs, and yeah, they're selective, but where's the good information? Where are the good catalysts in the short term that are going to, and that are big ones, right? What's going to help this market? I don't think there's a lot that I can find right now. So that, to me, usually, right, in a vacuum, the market, if there's no bad or good news, the market does tend to grind higher. But I don't think we're going to be in a vacuum. I think the news is going to continue to deteriorate. That's really more of a gut art call. So don't take that with a super grain of salt from the Himalayas or something like that. But yeah, so they did a great job. I mean, this has been an incredible rally. We were fortunate enough to switch to really respecting it for some reasons, right? Early on, not too far after the low got put in, but the breadth correcting this week, it's just telling me it's risk off, right? So that tells me the phase of that correction should really be upon us, with breadth really starting to get rocked. It's not like, oh, just a few stocks got smoked. No, they started selling a lot of different stocks and sectors. So remember, here's the risk, and this is what the paths, what path the market takes, and your position management's got to be critical. And that's because, as I note here, fresh and heretofore feverishly frustrated shorts are likely to already be drawn back in, or will be further drawn in. So they might feed, right, the next short squeeze, which is what happens during rallies inside of corrective or bearish phases. And this is really the same as it's always been. Once I got my feet wet with charting and learned a little bit about it 3 decades ago, roughly speaking, I started realizing what happens, like how, and that's just the behavioral aspect of what's up inside of a bear market rally, or inside of a bearish phase where you still see tremendous rallies, and they're very sharp, bright, quick, and you got to trade them because they're money makers. But at the same time, they're a counter trend trade, so it's a little trickier. But it can be death to remain in for too long. So what I did want to show you one last time, if I can guess the right ones again, and that is not a good guess. And this one maybe is a good guess. Yeah, so this is a good guess. So I think I'm going to end on this for everybody. So let's get ourselves to the lows of 22, which are there. So I just want everyone to see, and let me try to blow this up a little bit more, and then we'll end on this one, because I know this has been a long one, but I'm sorry, like, I think it's a critical juncture. So I'm doing what I think is right. You just got to do what you think is right. That's my way of going about it, even though maybe it doesn't suit everybody. Like I said, I would skip to these charts if that were the case. But look, market bottomed out. Am I on the right? Nope, that's not the right year. I was gonna say it looks different than I thought it would. And there it is. So I just want you to see this, right? So here's your double bottom and let me switch over to the SPY. It's just, I feel better. It's not really a big difference, but just talking about the market, the S&P. So I apologize on this, but I got to get us to the right spot, and I got to get decent magnification so everybody can see what's going on here the right way. And I think it's going to put me, that should do it right there. So I just want to show everyone, right, that the October lows that this is the right, yeah, this is the right year. Come on. If the computer's not liking something here, this is not supposed to be in my way. Okay, it's finally left. So here is your October. No, it isn't. Did I go back further than I realized again? I'm so sorry about this. I don't know why it seemed like I'm there. And then the computer might be hesitating with all this data. I have too much stuff running as usual. You can see here's your low. And you could see really in terms of SPY, it was a lower low, significantly lower low, and then a strong reversal. And it's been up, up and away. And so if you look at this, notice, right, the breadth started to improve, not that far thereafter. And this high here, right, got taken out, 10.5. That was taken out by there. And remember, the summation index is the slow mover. Notice the McClellan oscillator, and notice, right, the higher low on the McClellan oscillator at the low. So that's your positive divergence. Here, you kind of leveled off. It didn't get worse. And that's probably because you had that reversal day, right? That you basically double bottomed on this cumulative volume index that I like to look at. So I'm not going to go through all the different breadth measures that we spotted at the time, but we didn't say, hey, this market, it's over. We waited for more confirmation, but when they started taking out the high, and then they started taking out this kind of cheesy little high here, it started to, you were willing to take it, a little more. And then when they put this sort of cluster low in for a few weeks, which was very far above here, then they started to advance again. You got to trade that thinking there could be a trend change, take that out. Again, once they took out those highs, they did back them off again, but still held above here, second higher low. It just kept going. And that starts looking, when you start seeing that the breadth just keeps improving overall, that's a good sign. So you become more of a believer. So I just wanted to note that, because if this is more of a corrective phase that goes on longer than maybe I'm thinking, right? Maybe it's not just for a few months. Maybe it's through a lot of the rest of the year, maybe beyond. We're going to want to look for those signs again, right? To start thinking, okay, it's over. There's been full capitulation. Now it looks like money's starting to flow back into the market. And that's the bottom line in the end is money flowing back in the market, and or flowing out, right, on balance. And it's tough to say that. Some people, I'm sure, have got great data on that they pay for it or they do it themselves. But I just have my technical ways of doing it and some of the stuff we've seen. So I just want to say thanks for tuning in. We'll wrap it there. I hope something I share with you helps you out this week. And let's see what else we have. Yep. And if it doesn't this week, I do hope that it helps you out in the near future. That would be really great from my perspective, that someone's lending a small helping hand for people that are trying to learn a little bit more about charting and things that have helped me. So again, I would stay in a very defensive posture at the moment, and or go on offense, right, to the downside if you're okay with that. I think hopefully a lot of people are that are with Market Rebellion, since we are all about that, depending on which way the wind's blowing. But the other side of this coin is, right, think about, while volatility is still reasonable, if they put a rally together and the VIX collapses, you may want to think about positioning yourself smartly. Again, we don't push things in the Phoenix, but I just think it's worth mentioning to people that are with us already. The Phoenix is a great spot for not only, I think, trade ideas, but for the discussion, with Ryan every week. And I'm in there, of course, too, but I got my hands full with other services and only chime in like here and there on the video during the webinars, because somebody's got to do that and someone's got to do what Ryan does, right? So we do the best we can between the two of us, and with Greg on some of the other services as well. And my son helps out a little bit too on some of the other services. So we're just doing the best we can with the staff we have. So again, have a great week. Keep yourself in a disciplined position management mindset. If it gets volatile and choppy, stick with your singles and doubles mentality, stick with your quick trim mentality, and just be nimble overall. And that's how you get through challenging phases. If you find things challenging when we're not running, a lot of people are used to running, bulls running, and they do very well during that phase, but they struggle when it's something else. So not an easy thing to get used to, but eventually people that stick with it do. So good luck to you this week. And thanks for tuning in again. And I will be back in touch with you in the various ways we always are. Have a great finish to your weekend.